I'm Ralph Sinsheimer, Senior Managing Director of Klingenstein Fields Advisors, and I'd like to welcome you to the first in what will be a series of conversations around topics of concern to nonprofits, their senior management, and their boards. Our discussion today will focus on the various models available to foundations and endowments for managing their organization's assets. We will also consider how to optimally approach the selection of outsourced consultants in the event a third-party provider is needed. Today, we are very fortunate to be joined by two highly respected industry leaders. Marc Mayer has been in the investment management industry for over 25 years. He doesn't look it, but it's the truth. He is currently the chairman and CEO of Manning Napier, a publicly traded $20 billion wealth and asset management firm providing comprehensive investment services to institutions, including nonprofits, and individuals. Marc also sits on a number of nonprofit boards, including the American Friends of Hebrew University, where he is chairman of the board and of the $800 million investment committee. Brad Alford has 3 decades experience in senior roles at CFO and other consultancies. He's also been in-house at Duke Endowment and the Emory University Endowment. In 2006, he founded Alpha Capital Management, a leading consultancy which designs and implements investment consultant and OCIO searches for institutions. Brad is also the creator of the Alpha NASDAQ OCIO indices, an important new tool in helping institutions measure the relative performance of OCIO providers. And I'm sure we'll touch on that as we go forward. Anyway, welcome to you both. Let's get right to it. First question. There are several options available to nonprofit organizations for managing their investments. Can you describe these and give us some idea of the types of organizations that might select one or the other of these options to help address their investment management needs? I throw that open to you.
Maybe I can start. I think it's an essential question, and at the heart of it, I think the issue is really one of capabilities and governance. So larger organizations that either have the resources to have professional investment staff or to put together robust investment committees or to put together robust investment committees, can consider trying to do this themselves, set the asset allocation, pick the underlying investments. But in most cases, in organizations that are not large enough to have the resources, in particular for professional staff, it really does make sense to turn to outsourced CIOs or others who are capable of providing those types of services. And I don't think there's a single cutoff. I mean, it's easy to say, well, if you're a $1 billion endowment or foundation and you have a CIO and maybe more staff, sure, go ahead and try doing this on your own. I think there are a lot of endowments and foundations that are larger than $1 billion, and Brad can certainly comment on this from his experience, that have decided to go to outsourced CIOs for simplicity, for better governance, and ideally to generate better results. And then there are smaller organizations that for some reason believe that they can go it alone. But the demands on an organization to manage assets of whatever size are great. And I think the very, very rapid growth of the outsourced CIO business over the last couple decades really represents the understanding that continues to grow within the not-for-profit world, that in many cases, probably in most cases, it really is not necessarily the best choice to try and make all these decisions yourself.
Let me just follow up on that and just ask the question, To the extent that investment committee decides to go it on their own, what is the burden from a fiduciary standpoint, and is it alleviated by going with an outsourced CIO?
I'll answer that one, Ralph. It was interesting, 4 or 5 years ago, some people were looking at OCIO because they thought they would transfer that fiduciary liability completely to the OCIO, which isn't the case. Legally, it's a shared responsibility. And so even in as we do, we're a search firm, we do searches big and small, 20 billion down to our smallest one was the Statue of Liberty, which was a really interesting one, which was only 40 million, but too cool to turn down. And really with both of them, OCIO and to separate non-discretionary, so OCIO, Outsourced Chief Investment Officer, and non-discretionary, which was the primary model back in the 90s when I was at Duke and Emory. OCIO used to be called discretionary consulting, and now it's called OCIO. But where we draw the line in the sand when you've gone OCIO is you've given your advisor the ability to hire and fire managers without the board's approval. Both situations, you still have to set the investment policy statement. Still, a lot of committees say, oh, I'm OCIO, what am I going to do now? You're doing the most important thing. You're setting the asset allocation and the bands, lower and upper bands, and different asset classes. So even if you go OCIO, you are still responsible for the majority of the return based on asset allocation from the investment policy statement. So, Ralph, that's hopefully not too much for kind of a little bit of the governance side of it.
So this might be redundant, but ultimately, what leads institutions to seek out outside help? You've talked about governance, but I just want to make sure we're getting it all.
We're seeing it more on the nonprofit side. I mean, I'm not going to talk about pension funds, and it has a lot to do with funding status, where pension funds are handing it off as their funding status has gotten toward 100%, and they want to sell the pension fund to some type of an insurance company, and they may want to go OCIO because it's mainly fixed income. But for nonprofits, for the audience today is, most nonprofits, the board is, I sit on a couple of nonprofits myself, you're a voluntary committee, you meet quarterly, the markets move daily, especially with some gyrations that happened in March with COVID and future ones that'll happen. And OCIO really has their finger on the pulse of the markets more, and committees are more focused, especially on nonprofits, on really giving the money away with what it's there for. So I think a lot of nonprofits are going OCIO is because they just don't really have the time for it, to be honest with you.
Got it. So it's no secret that outsourced CIOs, those services has really exploded in terms of their growth. Brad, I think you probably know it's about $2 trillion. Last time we looked, and about 5 years ago it was half of that. So it's really sort of starting to happen. But it also makes things more challenging because there are so many of them. How do you differentiate, and how do you figure out what would be the best fit for an organization in terms of size, in terms of kind of services they have? I'm going to make that open-ended for both of you. What makes an attractive OCIO?
Mark, you want to hit that one first, and I'll follow up?
Sure. I'll start. It's a topical question because Ralph mentioned one investment committee that I sit on, which is actually, and I'm going to contrast two things, which I hope will be helpful here. So one committee that I'm involved in, that I chair, as Ralph mentioned, is it's an $800 million endowment, which quite unusually is entirely managed by the committee. Right? No professional staff, no outside consultant, no outside advisor. It's entirely managed by the committee. We meet every month, and we have subcommittees that meet in between those, and their emails back and forth frequently. So it's quite a considerable time commitment. And I think unless you're willing to commit at least that much time, I think it's very, very, very hard for a committee, even if it has investment professionals on it. It's hard to manage this because, as Brad said, if you meet once a quarter, the markets are moving and you're just not on top of it. Another investment committee I sit on is much smaller. It's for an independent school, about 60 million of endowment and endowment-like funds. Similarly, the committee was managing that money for the last decade and did okay, not badly, nothing great. But I think we were meeting quarterly and realized that, you know what, this is really not the best governance. And the professional staff at the school, they had a million other things to worry about, right? They're worried about capital plans, about scholarships, about payroll, and a million things. And so they didn't have the time to sort of deal with a lot of information coming in, putting together performance reports and so on. So we did a search for an OCIO very recently, reviewed a couple dozen RFPs, brought in 5 finalists, and made a selection. And so getting to the very specific answer here, I think the obvious answer in all these situations is what's the right OCIO for you is it depends. But it was a useful search because we looked at very large and very small OCIOs. We looked at traditional asset management consultants who also implement discretionary portfolios. And a lot of it ultimately boiled down to demonstrable skill, fit, chemistry, and ultimately all of that turned into trust, because you're going to entrust your money to these folks. That's a forecast, right? You found out how they did for other people in the past. You're making a forecast. But I think that coming to that point of perspective on trust really did require very tangible evidence of what do you do, how do you do it, and how well did it work historically, and then an awful lot having to do with, does this feel like it's really going to work for us? And I think every one of the finalists that we interviewed in that particular case was highly qualified. Any one of them could have done a very fine job. We ended up picking by far the smallest one, a very fine firm. And I think there's a lot of information in that, but at the end of the day, we felt the greatest alignment of mission and a high degree of confidence that they would be able to really deliver what the school wanted.
Well, I'm sure we're going to dig into that, but let me just ask you to elaborate on the process. For example, who was it that created the RFP?
So the RFP was, the staff. So there's some interesting observations in this. So the staff takes a first stab, and what they do is they reach out to colleagues in the community that have done the same thing. Right? It's crazy to an RFP is a very complicated thing. Right? Anybody who's ever put one out there or responded to one, a good RFP is a very complicated thing. It's not just because it's long, but a really good one asks important questions. So you don't have to figure out how to do this on your own, right? There are others in the community who have done it, and there are consultants like Alpha Capital that absolutely can help you prepare this. So the staff kind of gets started, but then goes to the members of the committee. And even though this is not it's a small pool of assets, $60 million, not enormous. It's a sophisticated investment committee. Senior person from Blackstone, former Goldman Sachs partner, somebody running a $5 billion hedge fund that he founded, somebody who's running all the public assets for New York City, right? So it's a good committee. And they weigh in from their various perspectives as asset owners, asset managers. You should ask this question differently. We should ask that question. And so it's a just getting the RFP done is a big process. And in it, you see both in the getting it formulation and in the response, you begin to see some important dynamics, which are what's really important to the committee versus what's really important to the staff is not necessarily the same thing. Right? The committee, especially if it's made up of a bunch of investment types or people who, even if they're not in the investment world, are really into it, are going to look a lot at investment-like stuff. The staff, especially if they're not professional investors, which they almost never are, they're going to be all about the reporting and the administration and the ease of use. And I know in the case of the school, for instance, just one specific point, they were very, very, very focused. Big thing for them was in the RFP, do you manage money for people like us, which in their mind was independent schools of about our size. And the committee said, I don't care, right? It's like, we're a not-for-profit, right? It's like, it's a school endowment, a church endowment, a hospital endowment, it's a foundation. They're not that different, right? So, but the staff is, no, they have to understand us. It's like, no, not quite the way you think, you know. It's not that important that they manage money for 200, private schools around the country. And so that's just an example of one of the areas where you might get some different points of view at the very outset of the process, developing RFPs, responding to reading RFPs, and evaluating RFPs.
Brad, you and I have crossed paths on a couple of situations where you've been the consultant to find a consultant, the search consultant, if you will. Can you let us know, first of all, is that observation that Marc made universal or nearly universal? That's number one. Number two is, what is the difference in role and the effectiveness where you're playing as a consultant versus a consultant for the search? Can you expand on what you do as a search advisor?
Yeah, great, Ralph. That's always with searches. Unfortunately, it's project work, so it's 3 or 4 months, and then we ride off into the sunset and hopefully don't see you for another decade. So terrible business model, but we come in and to your question, the universe, we wouldn't be in business if there weren't so many players now. We track about 100 OCIOs out there. Of the last 55 searches that we've done, say 30 different firms have won them. And so it's very tailored, what you want, endowments and foundations. They want a lot of alternatives. There's different flavors of OCIO, whether it's a single fund you invest in to different type of feeder vehicles, so it's something totally customized. And so, people bring us in for a variety of reasons. An RFP is, for us, is very proprietary. We have a lot of, over 100 questions. We've been doing it for years and years and have case studies. A lot of the firms are using artificial intelligence and they give you the same stock answers. So we put case studies in there. They're applicable to the client and make it very unique. We have a criteria ranking of what's important to the client. There's non-criteria, and we get the committee to sign off on, make them think alike. And so we feel like it's a tremendous amount of science involved in an RFP process, but it's a very dynamic business. I mean, we've been brought into, Kroger Groceries, one of the largest retailers in the world, and they have an investment staff. They brought us in because we know the landscape, we know how to negotiate fees, and that's become our biggest thing is fee negotiation. We almost always can guarantee pay for ourselves by multiples because we've done $90 billion of searches in the last 5 years, so we got a lot of buying power. So, I think people who use a search firm have made the right choice because it really helps, guide the process because it's a 10-year decision, so you really most likely need help.
Well, it seems to me that the science produces, in terms of the responses for the RFP, a lot of a book full for each of the 6, 7, 8, 9 prospective advisors. One of the things that is so important to your clients, I know for a fact, is you help them distinguish between the 6 of them, because you can't just do that by reading 100-page responses for 6 different advisors. So I think that's what is a clear value added for you.
Well, thank you. You're selling our own service. Thank you, Ralph.
I'm here for you.
Yeah, I would the OCIO search that I mentioned that we did at this independent school, we did not use a consultant like Alpha Capital. I think in hindsight it would have been helpful, and we created our own spreadsheet and the criteria and stuff, but there was a greater degree of science that I think a skilled advisor like Brad and his team would absolutely have been helpful.
Well, it's just
We
learn
talk
how to
about
ask questions. I mean, we have multiple part questions. It's like asking politicians questions. They give us vague answers, and so we figure out to have, we'll have, if it's 100 questions, but several questions have multiple parts. They're decision trees.
talk a little bit about performance. How do we get a level playing field? And I know the Alpha NASDAQ indices, we'll talk about that in a second. But what historically has been the problem for nonprofits in looking at various prospective advisors or OCIOs who don't have a track record that they can provide, or say they don't?
Yeah, it's interesting because in terms of track record is, there's a standard called GIPS, which is Global Investment Performance Standards, which the CFA created. And so, it really was originally created for the money management industry, where they would all follow these standards, so their track records would be, I call them real. And so then the consultants and OCIOs would know that these track records were real track records. And so now every money manager is GIPS compliant, even going to the hedge fund and private equity world are now being GIPS compliant. The OCIOs, when you ask them to go GIPS compliant, which is ironic, most of them won't do it. There's probably right at 15 of the 100 or so that have gone GIPS compliant. And so we're starting to see more people go GIPS compliant, but the problem we get, and we ask a lot of track record questions, unless it's a GIPS compliant track record, then there's a lot of cherry picking going on. It's just not, they're not real numbers to us. And so that's the hardest thing. Until the whole industry goes GIPS compliant, which I think is going to be a while, then track records are always going to have a lot of asterisks by them.
Yeah, and it's not just the CFA Institute, GIPS, the standard that Brad's referring to, ensures that it really is robust, right? That you're not just picking and choosing, that it is a true composite that is absolutely reflective, right? The other challenge that you have, beyond the fact that 85% of the OCIOs out there aren't yet GIPS compliant, AMER compliant, is that what they are going to present is going to have all different kinds of asset allocations. And, and most of them will do a pretty good job of saying, look, this is what's in here. This may not be the asset allocation that we arrive at for you, but, this is what we have that we can legitimately present, or more or less legitimately present. And then, this is the case that I had in the search that I'm talking about. You end up with, okay, this one has 10% alts, and how they define alts is not always the same. Some put commodities in there, some don't. Some are, it's 10% alts, but 8% of that, 80%, 8 out of the 10 is hedge funds, 2 is private equity, another one has 30% alts and 40% alts. So what exactly are you comparing? And it's truly challenging. It's truly challenging, and I think requires some real serious scrutiny. You can't take any of this stuff on face value yet. You just can't yet.
So Brad, this is an opening for you for the indices that you've partnered with NASDAQ on, because it seems to me they get to the heart of the opacity that's inherent in the management of nonprofit assets. They do this in part by having specific size and style, but more importantly, risk-based. So before I butcher this, why don't I hand it to you to explain how you've come upon these different indices?
Yeah, well, thanks, Ralph. And I'll try to keep it short. My partner Anna doesn't. I'll start talking about these indices. They're like my fourth child. So we were doing a search 4 years ago, an OCIO search, and obviously our clients want to see track records. You're hiring an outsourced chief investment officer, so much like hiring a football coach, you want to see their past record. And so the whole answer is every client's different. We don't have a track record. It doesn't really go very well with, when we're doing a search and showing it to a board. And so I thought there should be something like the hedge fund, HFRI indices, where the OCIOs would submit performance to a third party and someone would create indices. And we went to the largest kind of 30 or 40 OCIOs that we deal with And so would you participate? And they all said yes, but you need to find a partner that would, ensure data security. And we approached NASDAQ, and NASDAQ's one of the largest index creators in the world, and they liked the idea. We formed a partnership with them 2.5 years ago, and so we have a portal, the alphanasdaqocio.com. You go there. These OCIOs have a template. They upload on an anonymous basis all of their clients' real performance. So we don't have to worry about GIPs. We aren't asking for composites. GIPs has to go with composites. So we're actually getting client level performance as well as asset allocation across 25 asset classes that we created with NASDAQ, really the taxonomy of the asset classes. And so now, started off slow. We had 12 OCIOs. We now have 43 OCIOs. We're very excited about that. We have 4 or 5 joining every quarter. We have people now approaching us saying, hey, you can't beat them, join them. We believe in transparency. We want to be part of this. And we now have 1,100 underlying, of the 43 OCIOs, 1,100 underlying institutional returns, as well as asset allocation going back over 20 years for some of the older firms. So it's been great. We have 10 indices. We have one broad one for client base. We do have an endowment and foundation index, and then we have 5 risk-based indices. So it looks at the asset allocation and puts them into 5 risk buckets, so you can really create more relevant performance analytics versus, that if it's aggressively invested, you want to look at an index that's aggressively invested. So we're excited about it, and we hope to get the whole 100 OCIOs, and hopefully we'll be there one day.
How does this get distributed? Does it cost money? If I'm sitting at a nonprofit and we're contemplating a search, how would I be able to access the data?
It's absolutely free. To participate is for free, so there's no pay for play at all. And you can go to the portal that the OCIOs go to. As it says, alphanasdaqocio.com, sexy portal name. And you click on the bottom for view latest results. It'll show you the performance. You can go to our website, alphacapitalmgmt.com, and click on OCIO indices, and you can get the performance there.
Great. It's a great service. Let's see where it goes. We've talked a bit about performance, but the flip side of that is, how do you recognize and assess a consultant's or OCIO's ability to manage risk on behalf of the organization that's hired him? Again, wide open question.
Mark, go ahead. I don't want to hog the whole.
Sure. Well, I think it's important, and I think this is one of the things you try and get at in an RFP. It's important for the institution to understand how it thinks about risk. And again, if it's not if there's not professional staff and a sophisticated investment committee, I think this is where a consultant like an Alpha Capital can be very, very helpful, because the standard definition of risk that everybody sort of carries in the pocket of volatility is imperfect and incomplete. And so I think understanding what the real risk is, and one of the things I've always tried to do on investment committees that I've been involved in, when the conversation gets in the weeds, which always happens when you got a bunch of investment geeks, is sort of try and pull back and say, look, the fundamental question here is, if global equities or whatever, but equities being the most volatile piece, if global equities go down 30% and they don't bounce back in 2 weeks, how does that affect the underlying institution? And if the answer is it doesn't, then it's like, okay, you understand that you can live with volatility, you can live with illiquidity, there are a variety of things. But I think asking fundamental principle questions to try and elicit how an organization thinks about risk is the first way. And at the end of the day, all investments are a set of trade-offs. You want more return, you have to take more risk. You want more return, you have to embrace illiquidity or leverage or concentration, right? There's all these things that you want more, or you got to pay more fees. And the reality is, well, it's all of the above, right? So what is most important to you? And if somebody says, well, gee, I'm terribly fee sensitive and I cannot stomach volatility, and then that will drive you, in certain directions. And the OCIOs you're interviewing, have to understand and have to elicit from you what those preferences are and what implications they have for risk. Because risk is not just volatility, it's the permanent loss of capital, it's sequence of returns because you're taking constant withdrawals, it's illiquidity and kind of getting stuck, right? So it's all these things that we know, and figuring out which ones are really important to the institution, I think, is of absolute paramount importance. And then you can try and evaluate people. Well, how good are they on the ones that matter the most to me?
Terrific answer. Thank you, Marc. Anything to add, Brad?
Yeah, I just want to say risk, and I'll put it from a nerdy CFA's point of view, just driven by your asset allocation, which in turn is driven by your investment policy statement, which is something the board works with your OCIO, and which is the risk is typically driven by your return expectations, which for a nonprofit is typically CPI +5. So I mean, it's going to be very equity focused, long time horizon, perpetual, most likely. So I think your investment policy statement is something, the document that drives the risk you're going to take, and the OCIO is the roadmap that the OCIO uses to invest your assets.
Okay, I've got a couple of questions, and then we can open it up if there's any questions that have come in. The first one is the role, as you see it now, of ESG and diversity, equality efforts. What does the consultant who's an OCIO need to have to meet those queries or those policy interests? Brad?
Boy, ESG, we started to see that pop up about 3 years ago. We did the search for the Nature Conservancy, which is probably the largest of the E's. And we realized that a lot of firms were fake it till you make it. And a lot of formed committees and ESG. Now it is the hot dot right now. In the last year, especially doing a lot of community foundations, we're seeing diversity and inclusion becoming very important, but it's very early innings on that. And so trying to assess it is certainly very new, and we're still getting our arms around it. But there are firms that are ahead of the rest that are really doing it for the right reasons, rather than it's just a big market opportunity for them.
Yeah, and I would add it's the magnitude of the concern is very individual and specific, both to the institution, but frankly to individuals who are involved in the decision making. So in Europe, and particularly Northern Europe and the Nordic countries, most especially, this is not the last 3 years. This became a big deal 25 years ago, and in many cases is absolutely central to the conversation at institutions. It's become much more important in the U.S. and I think is in growing importance at an accelerated rate. But they're going to be, and I've witnessed this, they're going to be individuals who say, look, we are fiduciaries. Our job is to generate, the highest return or the highest risk-adjusted return, however we want to measure that, for the institution. We're not here to save the world, right? Where our job is not to worry about climate change. It's to generate high returns. And there are other people who will say no. As fiduciaries, as stakeholders, it's a much more complex issue, and ESG is of tremendous importance. The diversity and inclusion of the managers that we are going to employ is tremendously important. And so I've just seen this over and over again, that within institutions, you can get very, very divergent points of view. But I think it's I think ESG is absolutely here to stay. I mean, governance has always been here to stay, right? The academic evidence that there are superior returns to better governance at the individual security level, that's been understood for decades. It's much harder to prove that for environmental and social issues because they are fundamentally much longer cycled, right? So you get into theoretical debates about well, is all of that oil in the ground a stranded asset, or isn't it? How much longer are we going to be petroleum and carbon dependent? Is it our jobs to worry about this, or is it not? Is it better to withdraw capital? All that does is create a higher cost of capital, which means an arbitrageur will take advantage of it and perhaps earn a superior return, and it will not, save the climate, right? So, I mean, there's a million complicating factors, but I'm quite confident that ESG will grow in importance on a material scale in our country.
Yeah, there's an interesting age gap. So the investment committees are all older, like the three of us, and they're focused on total return. Hey, you make more money, you have more money to give away as an endowment foundation, and then you get to the millennials and the younger generation. They're focused on their money matters, and I'm going to donate to a nonprofit where my money has influence and changes things. And so until that little bit of friction between someone focused on total return versus their money making a difference, the people that are giving the money are the younger people, so they're having a much more important word now. So if they say I'm not going to give you more money, that actually the endowments and foundations will start to listen. So that age gap is getting a little bit more narrow.
So I'm going to relate an interesting experience. So it's at this independent school I was referring to, and it's in Brooklyn, New York. And half a dozen years ago, we got a letter from a bunch of the school runs from preschool all the way through high school. We got a letter from a bunch of high school students saying, you must divest from from all oil and gas and coal and related pollutants. And we discussed it seriously as a committee. It's like, okay, what do we write a letter in response? Do we ignore this? And we said, no, this is part of what makes this school special, is that the students are respected as real thinkers at all ages, really starting at preschool. And so I said, let's go talk to the class where this came from, which was a fascinating exercise in really trying to help them understand what does it mean to be a fiduciary, a term they'd never heard. What are the priorities of an investment committee for an endowment? Is it return only, or are there obligations, broader obligations to society? The nuanced discussion about how capitalism works and what does it mean when you withdraw capital from a sector, right? It worked. We all know it worked in South Africa, right? And that's the model that pro-divestiture people will point to. But you explain to them, well, why was that a special case, and why is something like energy fundamentally different? And it was a very we ended up not divesting, and I think there was a good understanding in the student body that this was not a moral judgment on our part, that it was a fundamentally complicated issue. But now the conversations come up again as the school is about to bring on board an OCIO. Is it time to rethink it? The head of the school, got his doctorate at Harvard and worked as an administrator there. Harvard just announced that they're going to divest fossil fuels, with the exception of some, tiny percentage that's still in some private equity funds. And so, the conversation is back, and I would say our thinking continues, it's evolving, including, the three of us who went to speak to that class a half dozen years ago. We're like, you know what? Maybe it's time we really did do this. And does it help that oil went from 6% to 3% of the S&P in that time frame? Perhaps.
Well done. Let's talk a little bit about the service package that's offered by the OCIO. In many instances, it is predominantly, if not exclusively, investment oriented. In other cases, there are additional services that might be operational in nature, or might in fact be strategic. And by the latter, I mean a way to see the endowment or the foundation within the operating budget, capital capital budget, the ability to fundraise, etc., building models to help the nonprofit understand where they are in terms of the health fiscally of the organization. Are those ancillary services differentiated? Do they differentiate the offering?
I'll answer that. You know, it's interesting that I would say we're brought into it for research. Things are not going well. And we're kind of grim reaper. So if you're the incumbent OCIO, you probably don't want to see Alpha Capital involved, or usually the bad guy to make a change. And I would say 9 times out of 10, it's performance related, because that's what you're being judged on. As I said, you are an OCIO. And the ancillary services are important, and some do some wonderful, help with the nonprofits, educating large donors on how the money's being invested. ESG and diversity has become very important. But at the end of the day, it goes with your name. It's all about performance. It really is.
Yeah, I would agree. I think the services count and are absolutely helpful. I think there are organizations that can and do a better job of it. But at the end of the day, as Brad said at the outset, you cannot, as an institution, as an investment committee, you cannot offload your fiduciary responsibility. That remains with you when you become a co-fiduciary with the OCIO. And so at the end of the day, if in the judgment of the institution, if the results just aren't measuring up, that dominates everything else. You're not going to say, all right, well, they're really helpful to us on fundraising. There are great fundraising consultants out there, right? That you can retain those specialists if you need them. So I do think it's valuable to provide those services, and they are welcomed by institutions. But at the end of the day, you have to deliver the results.
Yeah, I'll give you a funny story on that real quick, Ralph. It's just a good side story. We did a search for a major SEC school, endowment, billion plus, and their performance was not great. And it's interesting, they even compared themselves versus all the SEC schools. And so performance is being re-ranked all the time. And one of their largest donors said, look, you guys don't know how to manage money. I'm just not going to give you any more money until you make a change. And so they ended up making a change. So performance, if you want to, you're a nonprofit raising money, people are giving you money or seeing what you're going to do with their money. And so it's good. It's very important to have good performance.
Well, that's obviously the critical first thing. But sometimes the binding of the trusted relationship, what I've seen is that these other services, which inure to the benefit of the staff in the operational side and to the whole organization, if you can help them build, for example, models that give them a much better handle on their fiscal strength. Anyway, let me close before we open it up with a question on fees. Brad, you mentioned it earlier, that one of the things you do is to try to help bring to bear some pressure on the fee quotes. How does a nonprofit look at fees these days from the standpoint of their negotiability and how they're expressed in terms of itemizing? What should a $30 million nonprofit expect versus a $230 million nonprofit versus $1 billion? What is the norm?
Oh, there is no norm. I can tell you fees are dropping drastically. 4 or 5 years ago, even some of the OCIOs, and there's still one that still does this, takes a performance fee. So that's all gone away. And they were charging almost double. One was charging triple their non-discretionary fee, but they've come down drastically. I can just tell you, obviously, larger pools of money have more negotiability on fees. But it's right now it's a land grab, and unless you have not just to sell, it doesn't have to be Alpha as a search firm, a search firm who understands fees and how they're getting paid. I mean, some of these firms have proprietary products, so they come with a very low 15 basis points on top, but they're using all their products and making fees inside of those. So fees are very hard to get your arms around, and understanding how they're making money off you is critically important.
Can you give the folks out there who might be considering hiring an OCIO 3 or 4 basic things to look out for?
In terms of fees?
Yes. Either in terms of, go ahead.
Well, the trickiest one is they use proprietary products. And so you look at a top line fee, and then they're making fees inside their products. And there's just a lot of OCIOs that use proprietary products. I mean, that is the problem with going OCIOs. You've given them the ability to hire and fire managers, and that manager may be someone who works down the hall from them. And so they'll use proprietary products. So that's, very important. I mean, reading their ADV and understanding the way to get paid, that's what I call the true term as ADV, which they file with SEC. It's got a lot of the dirty laundry in there. And then asking them for an all-in fee. A lot of clients want to see what's the all-in fee, and then they'll game that by putting mainly passive inside there, showing you that inside fees are very low and very low alternatives. And then what they actually do is they go all out. Once you're hired, they've hired you, they'll be heavily inactive and heavily in alternatives with a lot more fees. And so fees is the most difficult question. Understanding track records and understanding the way they make money off of you are the 2 most important things you need to look out for.
Yeah, if I could comment briefly, I made I said something at the beginning about, a critical element of the decision was ultimately becomes a factor of trust. And this is a gloss on what Brad just said, but I think real transparency is the most valuable thing, right? If you're interviewing an OCIO candidate and they say, full disclosure, 25% of our equities are managed by our in-house team. They get, the fee on that is this, that money goes to our firm. I would then trust them. Now, I may not choose them, I may not like it, but I know what I'm getting, right? And the real challenge here is when you sense that there's something less than full transparency. And I'm at least as a decision maker, if I have transparency, I might be willing to take a higher fee from somebody if I really know what it is I'm paying and why I'm paying it, and how I'm paying it, where I'm paying it. Because sometimes when the fees look low, they're not, as Brad said, they're not as low as you think. And that absence of transparency, I think at the end of the day, is fundamentally more destructive.
Great. That's a good place to take a rest here. We don't have much time left until the witching hour, but I want to thank both Marc and Brad for sharing their experience, their expertise, and their obviously valuable insights to these important issues. At this time, I'd like to open up the call for questions. Again, if you're listening through your computer, you can submit questions through the widget on the right of your screen, or you may also email any questions to Mildred.Palo, P-A-L-O, at Klingenstein.com. Mildred.Palo at Klingenstein.com.
Well, great. That was really great. We had so many good points, and I think everybody really enjoyed it. We did have a couple questions. We have time for 2 to 3 questions. First one is an interesting one. Obviously, we've talked a lot about the investment side, performance, pricing. We have a listener who's wondering how important is technology capability and the investment management process of an OCIO in deciding who to work with? Where does investment technology rank in the list of criteria that you mentioned, Brad? And this may obviously vary by firm searching, but pose that to you first and then open it up to Ralph and to Marc.
Yeah, it's certainly important, and the OCIOs are realizing they have to invest in what type of performance reporting. A lot of them are using third-party firms, but it's a factor, but it's not of our 10 criteria. That's not one of them. It's kind of an ancillary factor, but certainly could be something you should, if that's important to you, you should ask about it.
Great. Well,
I think
thanks.
from a manager research perspective, you need the basic levels, both the data feeds and the way to manipulate the data in a way that is effective.
Yeah, and I guess technology like using investment for manager research, Morningstar Direct as well for some research. So definitely some of that basic blocking and tackling in terms of research, you definitely need to have.
But also making sure that the team is connected and there's a way to have notes on managers and clients for that matter in a way that allows you to crystallize your thinking and make moves when you think that moves is appropriate.
Great. Next question is an interesting one, and so I would love to hear the answer. Do you have any insights on why relationships go bad? When do selections do not work out? Is there any themes that you can think of, and is there anything one can do to, in preventative measures to make sure that doesn't happen?
Go ahead, Brad. You just mentioned one of the searches you've been brought in on that.
Yeah, I would think that, a lot of times when we do searches, I said judge your performance is the main factor, but a lot of new investment committee chairs, they want to put their fingerprints on it. So we always excited to see a new investment committee chair, because that may mean there's at least a review. But I think some of the we hear that an OCIO or a consulting firm may not be headstrong. These committees are, especially nonprofits. People on the line know they're loaded with people who have been very successful, alpha males and females that are used to getting their way, and so they want to a firm they work with is also headstrong as well, that will challenge them as a committee. And so they don't real passive people that they're investment advisors. So I have seen that before. But I would say, as I said, number one is it's performance. They're no longer in the top half of whoever they're comparing themselves to.
Great, thanks. That actually leads nicely to the next question, which it seems like we kind of know the answer to, but it's an interesting question. Do you find that there is wide variation in performance of OCIOs, or is it really more in a kind of a narrow band with some limits on either side?
Mark, I guess I don't know.
Brad, you have the database, so I would be just offering anecdotes. You actually have the numbers.
Yeah, 5 years and shorter, there's pretty large variation. It's not like private equity where you may see 10 to 12% spread between top and bottom quartile. Here you're seeing 2 to 3%. I think the biggest disappointment we do a search is that the committee sees and expects someone that's compounding at 4 or 5% more per year, and it's just not out there. Everyone's running a very broadly diversified portfolio, a lot of manager overlap. When you get to 7 to 10 years, I would say between top and bottom quartile is 1%. But if it's a $500 million pool of money, 1% a year over a decade is a heck of a lot of money. And so that 1% with compounding is very powerful. But yes, there is nobody that's beating everybody else by 3 or 4% over, the kind of 7 to 10 year time horizon.
Great. Yeah, no, great point about the 1% or even a small fraction of 1% still making a huge difference for a large endowment or foundation. I think we have time for one more question, and this is also an interesting one that I'd love to hear perspectives from all of you. A lot of new entrants to the market every day. Somebody hangs out their shingle or they break away from a university or something like that. How important is the fact that you've been in the business for a while? How long do you think somebody has to be at it independently before you feel comfortable saying, for your board, yes, I would recommend them, or Brad, you would say, yeah, I would recommend them?
Mark, I don't want to answer first.
I'll start off. I think it's certainly, there's no question it's helpful to see track record as, as an organization, as an OCIO that's, more than 5 years, right? There's no question. Now, if somebody comes out of a, highly esteemed university endowment or foundation, where, what they accomplished at that place, to the extent you could attribute it to that person or to that team, which is not always easy to do, there's absolutely a greater leap of faith there, right? So you're sort of the people that come out of the high quality endowments and foundations. They've learned well, they've trained well, they have great experience. They generally do well, but I think there's usually a greater degree of comfort, particularly if it's a consensus decision-making process, where you can look at a live track record for that OCIO entity, that is 5 years or more, for sure.
Yeah, I'll add to that, and definitely to Mark's point, I'll give you a good example. The folks from Wake Forest spun out and started Verger, and so they had a 10+ year track record running wakes, and they continue to run wakes endowments. So very comfortable with, they've seen it. The folks that I worked with at the Duke Endowment started Global Endowment Management. So even though new firm, that was well over a decade ago, but they've been running money for a long time. People coming from different firms we're seeing coming together that haven't worked together, that's a red flag. It really is, it's a land grab right now. I mean, it's like the hedge fund world was a decade ago. Everyone, OCIO is the hot dot, everyone's getting into it, whether it's the banks, the private wealth, whoever it may be. And there's going to be a big shakeout. There's going to be a consolidation. You've seen some acquisitions already this year. So we'll see where it goes, but it's exciting and it continues to grow, pretty rapidly.
And if I could just add, I'm sorry, Ralph, just an interesting, comment, because most, not all, but many of the OCIOs are started by talented investors coming out of the endowment foundation world. They may be very skilled investors, very skilled at manager selection, asset allocation, risk management. In many cases, they don't have a lot of managerial experience. They may have managed a small team, and they almost always have no sales experience. Now, that's not necessarily terrible, right? Because you're not hiring these people to be salespeople. You're hiring them to manage your money. But if the organizations don't scale, they begin to have revenue problems and ability attracting and retaining very, very high quality staff, right? So there's, you don't necessarily want an OCIO for whom the #1 priority is growing and getting a lot of revenues, because that means, that is what they're most focused on more than your returns. On the other hand, there's some that actually don't know how to grow their business, and they hit a wall where they just aren't generating the type of revenues that are necessary to have the quality of organization that they need.
Mark has said it perfectly. I need not go answer it.
Great. Well, thanks. I think that is all the questions we have time for. Any questions that we didn't get to, someone will definitely follow up with you, and there will be a link to the webinar that will be sent out. And with that, I will turn it over to Ralph to close it out.
Well, I just again want to thank Mark and Brad for their expertise. They got us where we need to be in terms of the knowledge in the space. I want to remind listeners that we'll probably be having another webinar in a couple of months that may end up being on PR-related issues for crisis management for nonprofits. We'll talk about that more in the coming weeks. Thank you all.
Thank you, Ralph.
Thank you.